Welcome to Mastering Corporate Budgeting, a comprehensive guide. Today, we'll delve into the intricacies of corporate budgeting, examining key concepts, providing real-world examples, and answering some common questions. What exactly is a corporate budget? A corporate budget is a financial plan that outlines an organization's expected revenues and expenditures over a specific period, usually a fiscal year. It serves as a roadmap for the company, guiding financial decisions and helping to ensure that resources are allocated efficiently. Why is a corporate budget so critical? The budget helps organizations to stay focused on their financial objectives, control costs, and make informed decisions. It also enables companies to anticipate future financial needs and challenges, buffer against uncertainties, and secure investments. Let's look at the components of a corporate budget. A typical corporate budget includes revenue projections, expense estimates, profit projections, and capital expenditure plans. Each component plays a critical role in guiding the financial actions of the organization. Revenue projections. This is an estimate of the income expected from sales, services, or other sources. For example, if a company anticipates selling 10,000 units of a product at $50 each, the revenue projection would be $500,000. Now let's move on to expenses. Expenses are the costs incurred in the process of earning revenues. Expenses can be divided into fixed and variable costs. Fixed costs do not change with the level of production, such as rent or salaries, while variable costs vary with production levels, like raw materials or utility costs. An example to illustrate: a company has fixed costs of $10,000 in rent and salaries and a variable cost of $30 per unit produced. If the company produces 1,000 units, the total expense would be $40,000, fixed costs plus variable costs. Profit projections are another crucial component. Profit is calculated by subtracting total expenses from total revenues. It gives a clear picture of the company's financial health and guides investment and growth strategies. Let's take an example. Consider a company with total revenue of $500,000 and total expenses of $400,000. The profit would be $100,000. Finally, a capital expenditure plan outlines the funds allocated for long-term investments like equipment, property, or technology upgrades. These investments are essential for sustaining and enhancing the company's operational capacity. Now let's dive into a real-world example. Suppose Acme Inc. is preparing its annual budget. They predict $1 million in revenue, fixed costs of $150,000, variable costs of $400,000, and plan a capital expenditure of $100,000. What would their profit projection be? By applying our formula, the total expenses, excluding capital expenditures for simplicity, would be $550,000. Thus, the profit projection would be $450,000, $1 million to $550,000. The capital expenditure indicates future growth potential. Now, let's look at some common questions. Q1. How often should a corporate budget be updated? 1. It's advisable to review and update the budget quarterly to account for any changes in the business environment or operational conditions. This helps in maintaining relevance and accuracy. Q2. What is the difference between a static and a flexible budget? 2. A static budget remains unchanged regardless of changes in business activity levels, while a flexible budget adjusts with varying levels of activity, making it more adaptable and useful. Let's examine a survey. A recent survey showed that companies with a well-structured budget experience 20% higher profitability than those without one. In conclusion, a corporate budget is indispensable for any organization. It not only aids in financial management, but also in strategic planning and resource allocation. By understanding and implementing effective budgeting practices, companies can enhance their financial stability and growth prospects. Thank you for watching. Don't forget to like, share, and subscribe for more insightful finance tutorials. See you in the next video.